Okay, Ed Yardeni is joining us now, President at Yardeni Research. Ed, good to have you with us here. Good morning. Thanks very much for your time. So let's just start with the Jackson Hole Symposium and Powell's speech. What did he make of it? What's the message, and will market pricing change over the coming few days?
Well, I think that the speech was quite hawkish. It was all about inflation, and it was certainly an indication that the Fed is committed to bringing inflation down to 2%. As a matter of fact, Fed Chair Powell said, forget about 3%. There's some chatter out there that maybe the inflation target should be higher, and he kind of shot that down. 2% is our inflation target. That's where we want to get it down to. It was hawkish because he really focused on either keeping interest rates at the current levels if things continue to moderate and go in the right direction, or else actually raising them if, in fact, inflation does get stuck here, or if it goes higher. He didn't really talk much about under what circumstances the Fed would lower interest rates, but I think it's pretty clear that if inflation continues to moderate, there's a good chance the Fed will be lowering interest rates next year.
If inflation continues to moderate, right, that is, I think, the key point to focus on. Mm-hmm. But what do you do at a time like this in emerging markets like India? Because now there is this big fascination towards emerging markets, especially this year. Do you think a lot of that has played out already, or is there more to go?
Well, I think there's probably more to go. I would say that global investors are probably becoming a lot more discriminating. They're not just buying emerging market funds, no matter how they're weighted. I think they're becoming more discerning about which countries they actually want to be in. And I think we've discussed this before. One of the countries that is no longer viewed as favorably as in the past is China. China's economy is definitely struggling, as we've seen recently. The Chinese government has been lowering interest rates. They've been trying to ease conditions in the property market. But a lot of their growth over the past few years has been a result of the property boom, which has now turned into a bust. And the reason for that is way too much debt, too much capacity, too much expansion. And now as a result of that, real estate prices are weak over there, and investors are no longer plowing money into the property market. And that in turn is affecting the provincial governments because they sold land in order to raise revenues. So I think China's got some economic issues that benefit countries like India, Brazil as alternatives to as countries that are probably going to do pretty well as emerging market havens for global investors.
Okay, Mr. Yardeni, yeah, absolutely. I mean, China is resorting to all kinds of measures, including stamp duty cuts, just anything to prop up the stock market at this point, right? Let's see how successful that is.
Well, it's not working.
Yes, so absolutely. Take your point. Yeah, they've been trying everything on the property side and, short-term measures to prop up the equity markets. The question is, how do you see flows shape up for a market like India, where at the headline level there seems to be a lot of positive talk? In the near term, we've seen in the month of August, foreign flows have petered out a little bit compared to the deluge that we were getting in April, May and June. We have the G20 summit coming up in New Delhi. Lots of excitement ahead of that, I can tell you. So, what do you see, let's say, over the next 12 months? Do you see India continuing to attract flows, even if, say, bond yields remain as elevated as they are? And are you expecting that to play out?
Well, I think right now, look, you should continue to benefit from global flows. But I just compared India and China. I think it's also important to recognize that whatever happens in the United States matters a great deal to emerging market economies. And the dollar's held up fairly well here. Usually it's a weaker dollar that benefits emerging market countries. The price of oil has held up, but other commodity prices have been relatively weak, which is, again, a negative for emerging market economies. Not for India, because India is not a commodity exporter, generally speaking, the way Brazil is, for example. But I think much will depend on the global economic environment. It looks as though China's going to be weak, Europe's going to be weak, but the United States is doing very well, and that may provide enough global growth to benefit other emerging economies like India.
All right, we leave it at that. Ed, thanks a lot for joining us. Always great to hear that emerging economies like India will benefit, whatever it takes, right? 2023 has been a good year so far for India.